There's a market bigger than stocks, older than the Fed, and quieter than both. It decides your mortgage rate before Jerome Powell even opens his mouth. And almost nobody understands it. Everyone's obsessed with the stock market. Every headline, every app notification, every dinner table conversation. But the stock market isn't actually the most important market in the world. It's not even close. The real one, the one that quietly controls your mortgage, your credit card rate, and whether the economy booms or breaks, is the bond market. And almost nobody understands it. And that's not by accident. Because here's the thing about the bond market. It's boring on purpose. There's no ticker flashing green and red on CNBC. There's no meme stock energy. There's just yields, spreads, and a bunch of gray-suited people who'd rather you stayed confused. Because confusion is profitable. So let's fix that. Ray Dalio, founder of the largest hedge fund in the world, put it about as simply as it can be put. Watch the bond market. It's the backbone of all markets. It's the risk-free interest rate that determines what all asset returns are going to be. Read that twice. Every stock valuation, every mortgage rate, every corporate loan, all of it is priced relative to bonds, specifically the yield on US Treasuries. When bond yields move, everything built on top of them moves too. Here's how it actually works. When analysts value a stock, they don't just look at earnings. They discount future cash flows back to today's dollars, and the discount rate they use is based on long-term Treasury yields. So when yields rise, the present value of those future earnings drops, and valuations compress, even if the company itself hasn't changed at all. Same earnings, lower price. That's the bond market quietly reaching into your portfolio. And it doesn't stop at stocks. Mortgage rates are anchored to the 10-year Treasury yield. Not the Fed's overnight rate, the 10-year. So when people say, the Fed is cutting rates, mortgages should drop, that's not automatically true. The Fed controls short-term rates. The 10-year is set by supply and demand for actual bonds in the market. If demand for long-term treasuries weakens, yields can stay high even while the Fed is cutting. Mortgage rates stay high right along with them. Same story with corporate credit. When borrowing costs are low, companies issue debt cheaply, expand, hire, and buy back stock. When yields stay elevated, that entire machine slows down. Growth gets more expensive everywhere, all at once, all because of what's happening in a market most people never look at. So why doesn't Wall Street want you to understand this? Because the entire narrative sold to retail investors is dramatically simplified. Fed cuts rates, good for stocks. That's it. That's the whole story most people get. It's clean, it's quotable, and it's not the full picture. Because if that's all it takes, then why do stocks sometimes fall on rate cut days? Why do mortgage rates sometimes rise after the Fed cuts? Because the bond market, the actual backbone Dalio was talking about, isn't fully controlled by the Fed at all. The Fed sets short-term rates. The long end of the curve, the part that actually prices your mortgage and your company's valuation, is set by supply and demand for bonds themselves. Who's buying, who's selling, and how much new debt the government needs to issue to keep the lights on. And that last part matters more every year, because the US runs trillion-dollar deficits annually. That means trillions in new Treasury debt has to be absorbed by someone, every single year. If demand for that debt weakens even slightly, yields have to rise to attract buyers. That's supply and demand, not Fed policy. This is why watching Jerome Powell's press conferences is watching the wrong end of the story. It's the flashy part, the part that gets headlines. But the real signal is in the bond market. Rising long-term yields relative to short-term ones. A weakening currency. Gold moving. Those are the signs of a supply-demand imbalance that no rate cut can paper over. And traditional financial media skips this because it's not exciting. Discuss the term premium on 10-year treasuries. Doesn't trend on Twitter. Fed cuts rates, buy stocks. Does. So the narrative gets flattened into something clickable, and the actual mechanism, the one that determines whether your mortgage payment goes up or down, whether your portfolio compresses or expands, gets ignored. The bond market isn't boring because it doesn't matter. It's boring because understanding it takes more than a headline, and that's exactly why nobody's talking about it. But now you are. The next time someone tells you, the Fed cut rates so everything's fine, you'll know better. Because now you know where the real story's been hiding all along.